Welcome to this explainer. Okay, if you're planning to buy a home or an investment property in 2026, consider this your high-stakes warning right out of the gate. If you're still sticking to the outdated approach of, finding a real estate agent first and scrolling through Zillow late at night, you are making a fatal mistake, literally. In today's hyper-volatile market, that old-school strategy is absolutely going to actively cost you your dream acquisition. So today, we're going to completely rewire how you approach buying real estate.
Now you might be wondering, why is your home search failing before it even begins? Well, because jumping straight into looking at physical properties without locking down your capital first, it absolutely guarantees failure. It leads straight to what people in the industry call price range heartbreak. It's kind of like shopping for a Ferrari on a Honda budget, right? You fall head over heels for a $500,000 home, only to find out your true purchasing power is actually $400,000. In a market completely defined by high volatility and low inventory, there is no way you can afford to guess.
So, here's the bottom line. The 2026 market demands an urgent structural transition. We literally have to move away from property-centric acquisitions and adopt capital-centric strategies instead. This is the absolute golden rule of the game right now. You must secure the money before you ever look at a house. Doing it the other way around? Well, that's the fatal flaw that is sidelining thousands of buyers every single month.
Section 1. The capital-centric paradigm. Let's get into it.
And this brilliantly illustrates the massive difference between how things used to be done and how they have to be done now. The old way, it was agent first. You looked at houses, found one you liked, and then scrambled to find the financing. Completely reactive. The new 2026 way is lender first. It's totally capital-centric and, most importantly, proactive. You establish rigid budgetary guardrails up front. You verify exactly what you can spend, which then tells your agent exactly where to look.
To actually pull this off, you need to completely redefine who you're working with. You aren't just looking for a standard loan processor anymore. You need a financial architect. This is an experienced mortgage professional who actually engineers your long-term cost of capital. They dive in and do a super granular analysis of your finances, making sure you preserve your household liquidity. What we like to call your emergency fund. Because, let's be real, you definitely don't want to be financially strained the exact moment a water heater breaks right after closing.
So why is having this architect absolutely crucial? Well, just look at the grueling macroeconomic realities of 2026. Industry strategists, everyone from Morgan Stanley to Capital Economics, are projecting 30-year fixed rates to hover anywhere between a 5.75% floor and a 6.50% ceiling. And because of this, we're seeing a massive lock-in effect. Roughly 80% of current homeowners are locked into rates below 6%, meaning they simply aren't selling. This creates historically tight inventory, incredibly strict underwriting scrutiny, and super intense multiple offer scenarios for the very few homes that actually do hit the market.
Section 2. Weaponizing your pre-approval. Okay, let's dive into this, because there is a huge, massive difference between a flimsy pre-qualification and a true verified pre-approval. A pre-qualification is basically just a verbal overview based on self-reported information. Honestly, it means almost nothing to a seller. But a rigorous, weaponized pre-approval, that includes a hard credit review, verified W-2s and tax returns, deep asset verification, and an automated underwriting submission. That is exactly what signals to sellers that you are a verified, low-risk buyer whose financing is absolutely bulletproof.
As our sources perfectly highlight, in this environment, speed, preparation, and strategy matter more than ever. Think about it. When you're up against 3 other buyers, the seller isn't just looking at the highest price tag. They're looking for the surest closing. A fully verified pre-approval from a proactive lender lets you move with total confidence and just totally bypass all those other buyers who are only casually pre-qualified. But listen, once you actually get that pre-approval, you absolutely must maintain your financial architecture during the entire escrow period. This is literally where so many buyers completely ruin their chances. Do not take on new debt. Do not go out and finance a new car, no matter how much you want to celebrate the upcoming move. No job changes. And definitely do not make large, undocumented deposits or transfer huge sums of money without a solid paper trail, like a gift letter. Any of these fatal underwriting pitfalls can and will disqualify you just days before you're supposed to close.
Section 3. Achieving closing velocity.
Now, for the real estate investors out there, the real game changer in 2026 is the DSCR loan. That stands for Debt Service Coverage Ratio. Instead of a lender scrutinizing your personal tax returns and stressing over your personal debt-to-income limits, they actually evaluate the property itself. They're looking for a ratio of 1.25 or higher,
Basically, this just means the gross monthly rent easily covers the principal, interest, taxes, insurance, and HOA dues. If the property performs, you get the capital. It's that straightforward.
Now, what's really interesting about this timeline is 10 to 21. That is the exact number of days it takes to close a DSCR loan. Crazy fast, right? Because the lender isn't bogged down in months of agonizing personal income verification, you achieve this lightning-fast closing velocity. And this allows serious investors to beat out traditional buyers and actually compete directly with all-cash offers.
Seriously, conventional investment loans are such a slog right now. They cap you at 10 properties, usually force you to hold the title in your personal name, and drag you through a miserable 45-day underwriting nightmare. DSCR loans, however, they completely remove that ceiling for unlimited scale, allow you to hold the title in an LLC for crucial risk management, and close rapidly. It completely decouples your personal financial profile from your entire investment business.
Section 4. The Mortgage Insurance Nexus.
Okay, so you've got the property. Now you need to protect your family's largest asset from the scary risks of death, disability, or sudden loss of income. Looking at our options here. Mortgage protection pays the lender directly to clear the debt, which is great, sure, but it kind of leaves your family cash poor. Term life insurance, on the other hand, pays the face value directly to your designated survivors, offering total flexibility to pay the mortgage or cover other critical living expenses. And finally, please don't ignore individual disability. You are actually statistically way more likely to face a disability during a 30-year mortgage than premature death. This policy replaces a percentage of your income, so you can actually keep paying the mortgage if you suddenly can't work.
So, the crucial point is that true capital-centric planning definitely doesn't just end at the closing table. An optimized acquisition integrates insurance to ensure the home remains a safe, secure sanctuary. You are quite literally protecting the physical asset from total financial ruin by proactively managing the risk of the unknown.
Section 5. The 2026 Acquisition Strategy. Let's bring it all together.
Let's move to our action plan and see how this builds into a definitive, step-by-step roadmap for dominating this market. Step 1. Consult your financial architect first for a comprehensive financial audit. Step 2. Secure that rigorous, weaponized pre-approval. Step 3. Establish strict budgetary guardrails based on actual data, definitely not emotion. And finally, Step 4. Only then do you deploy your real estate agent to execute a highly targeted property search perfectly within those exact parameters.
So I'll leave you with this one final thought. Are you building a solid financial architecture for your future, or are you just simply reacting to the market? If you truly want to win in 2026, you absolutely have to abandon that outdated property-first mentality. Adopt this proactive, lender-led strategy. Secure your capital, protect your wealth, and go get that property. Thanks so much for joining me on this explainer.